from there, but welcome. And this is actually our third or fourth event in this series. We're tackling the whole question of what I'm trying to change and coin the phrase of cloud funding instead of crowdfunding, because that is a coined term, actually a defined term with the SEC, but essentially funding from the web. And so with me tonight are three entrepreneurs who have been successful raising equity capital, and in some cases pre-sale capital as well, from crowd sources. And we're really lucky to have them here. Not every CEO I have approached has agreed to speak and share the secrets and tips and ideas and watch-outs. So I very much appreciate that they're willing to share their learnings with this group here tonight. What I'd like to start, since I do absolutely no prep, is to ask you guys to do your own introductions. I'd like to start with Monisha. Please tell us about your company, a little bit about your background, and a little bit about your funding history.
Hi, I'm Monisha Prakash, co-founder and CEO with Lumo Body Tech. We use smart sensors and software to help people live healthier lives. We have two products, one which we just announced. It's called the Lumo Lift. And here it is. It's a very discreet, stylish posture and activity tracker. And our first product is also a posture and activity tracker that's worn around the waist. And it's more than a posture and activity tracker. It's a self-empowerment tool to help you be the more confident, the more attractive, the healthier you. And it's been a really exciting ride. We just completed a crowdfunding campaign that we did on our own website, where we were able to generate over 16,000 orders in 1 month. So that came out to more than $1.2 million in pre-orders. And this was our second campaign. We had done another campaign for our first product on Kickstarter, and we were able to generate $200,000 for that first product. And in addition to that, we've also used AngelList in the past to source leads for our seed round. Since then, we've also raised a VC round, a Series A of $5 million. So our funding history has sort of spanned the gamut from crowdfunding to seed funding to institutional money. And I'm happy to talk about all of those. And my background is I'm a second-time CEO and co-founder. My first company was in the consumer in the consumer internet space. It was in college financing. And I sold my company in 2009, wanted to do it again, wanted to do it bigger and better. And I think Lumo Body Tech is the company that I've always wanted to create.
And Monisha, how much did you guys raise on AngelList?
Well, so in our seed round, we raised about $1.1 million. I would say that about 400 to 500,000 of it came from leads that were sourced through AngelList.
Thank you. Michael.
Hi, everyone. My name is Michael Chu. I'm the co-founder and CEO of Metagram. And what we do at Metagram is we build a mobile app for clinicians, so for doctors and nursing staff to help them with communication. The pain point that we're trying to solve for is that doctors are probably the only people in this country that are still using pagers to communicate with one another. And I was previously in medical school, so I carried a pager around and realized how difficult it was to have a conversation with somebody about a patient while carrying a pager. And so what we created is a HIPAA-compliant, secure mobile messaging app that helps healthcare professionals to communicate both on a one-on-one basis, but also in groups. And so we've been selling our application to both private practices and also to hospitals and health systems for about a year and a half now. And we've been able to get a lot of interest. We have users at institutions around the country. Over 30 institutions have used our application, and we're seeing just a rapid growth in the use of this sort of technology. In terms of fundraising, we've done, we're still a seed stage funded company, but raised a little over $1.5 million in funding. And
from what site?
And so, yeah, so we've used a couple sites. Like Monisha, we've used AngelList to get leads. We've also used a site called MicroVentures, which is a broker-dealer crowdfunding site with accredited investors, and they've helped us raise a lot of money quickly for our company. And we also have a little bit of institutional money from some of Silicon Valley's bigger investment firms.
VC funding?
It's VC funded, but at a seed stage.
Okay. And you had mentioned that you were going out for another round. Is that active right now, or is that the VC funding you're talking about now?
We've been raising some money recently with some of our existing investors. It's, I would say, closing out. But some of that funding has also come from MicroVentures as well.
Okay, and that's all part of the 1.5.
It's what I can say is it's all, some of it is 1.5, but I there's other information that I can't disclose.
Okay, thank you. So you're actively out there right now.
We are essentially closing out our fundraising.
Okay, thank you. Please note that he can't talk about his current fundraising efforts. And that will be actually a significant fact later when we talk about different sites and different ways to approach the whole crowdfunding question. All right, Ilya, please.
All right, so my name is Ilya Lichtenstein. I'm co-founder and CEO of a company called MixRank, and we are in the marketing intelligence space. So we track a lot of different data about the online advertising industry as well as mobile apps and what advertising they're using. And advertisers, sales teams, and other kinds of B2B companies use MixRank to find new customers, to qualify leads, to find new distribution channels, and things like that. Started the company in 2011. We went through Y Combinator, and after that we raised a 1.5 million seed round. And I would definitely credit AngelList with most of the success of that fundraising. In fact, we, I would say, even struggled a little bit with fundraising before using AngelList. Of our 1.5 million, we got about 800K of that through leads from AngelList, including Mark Cuban, who found us on there and reached out and ended up leading the round.
Cool. And this actually raises a very interesting question, which is, it sounds like all of you have combined different sources, even in the same raise. So where did the other amount come from?
The other amount, actually, a lot of it came from introductions from customers, which I really like. But the really interesting thing about AngelList and the online fundraising is that even for investors that we found somewhere else or that we were already talking to, the online fundraising and the interest from that helped a lot. It helped move the process along. It helped motivate them before the round closes up to move more quickly. So I think it accelerated all of the funding that we were getting.
Okay, thank you. Now, am I correct to understand that, Monisha, you're the only person who has raised money on this panel anyway, from Kickstarter or through pre-sale? Do you guys have you guys? Okay. Okay, so that's another thing to note, is that some companies and or even product focus is more appropriate and suitable for the Kickstarters of the world, and others are not. But it's still possible to source funding from the cloud and from the crowd. All right, so thank you very much. I'm going to very quickly jump into the how do you source equity capital via the cloud. The first thing actually is with the understanding that in 2012 there had been a lot of SEC rulings handed down, private letters and so on, exception letters and so on. And so a lot of sites have come on stream. But some of you have raised money before that happened. And Michael, sounds like you're actually in the midst of one that is, operating post the SEC rulings. Let's talk about how long ago your campaigns were and how you think the landscape has changed. Why don't you start, Michael, because you're the current one.
Sure. I don't think for us, at least, it hasn't really changed that much because I think AngelList recently has also started kind of an online crowdfunding functionality to their site we're not really using that functionality, but it is something that I think a lot of potential startups are using. And so for us, AngelList has always just been a way to be introduced to investors. And
But AngelList exclusively allowed just accredited investors. Is that true of micro venture as well?
yes.
And is there a
Absolutely.
difference between how they operate versus micro ventures?
So I think with AngelList, they, in the past, before they started this online platform, was mostly just for introduction. So we would be introduced to people, people would follow our company, and then we would do the legwork of going to meet with them, have them interested in what we're doing, and then hopefully eventually get an investment. I think with their new functionality, what they're hoping to do is to make that process even more efficient and streamline that into just like a very quick, easy way of doing it. Microventures is different in that they're a broker-dealer, so they do take a percentage of whatever funding they raise, but at the same time, they do all the legwork. So, for example, when we first raised with them, it was in 2012, we did a lot of due diligence with their managers, and we did several weeks of due diligence with them, and them with us and our product and our team and our business. And once they opened up the offering to their members, we were able to raise a huge, not a huge amount, but a significant amount of our round within 2 days. So we didn't have to do any legwork with them. And at that time, we were the fastest raise in their history.
Wow.
And so for an entrepreneur like myself, it was a lot more efficient than what we had previously done with AngelList, which is having to set up meetings and do a lot of legwork ourselves.
But the difference is that microventures still focused on accredited investors.
Exactly.
Which means that you're not doing the general solicitation.
No.
Okay.
Yeah.
Those are legal distinctions that we will ask Agent Rich to help us understand a little bit later on in the conversation. Thank you very much. Monisha,
Yes.
talk about how long ago your fundraise was on AngelList, and you have Kickstarter before, and then you have your self thing after. What are those time frames, and how have those kind of processes worked for you?
So we did our AngelList, or we did our seed raise about 2.5 years ago, and that's the one where we did use AngelList to source a lot of our introductions. The guidance that I had gotten about how to make AngelList successful for you is it serves better as a magnifier or amplifier than it does as an igniter or initiator. What I mean by that is the advice I was given is, if you're raising $1 million seed round, try to get at least a third of it committed and then go on to AngelList. Because then you create this momentum, right? A lot of the folks on AngelList are looking for validation, and if you already go on there saying, oh, we've already got a third of our round committed, it's validation. The second advice that I was given is make sure that the person that refers you into AngelList has a good following, because what happened was when I did that, the person who referred us in, everyone who follows him got notification saying that he, had referred us in and was one of our committed investors. So again, it's additional proof, because AngelList, they don't know you, and they're looking for signals to say that you're the real deal, that they should invest in you, and especially if they see somebody that they already know or that they respect investing in you, then it just builds up that confidence. And so that's what we did, and ultimately, about I'd say 40% of that round ended up coming from from investors that came from AngelList. So that was that experience, and that's when we raised 1.1 in seed funding. And then I'd say about 6 months later, we did our first crowdfunding campaign through Kickstarter, where our goal was to sell $100,000 of pre-orders for our posture sensor, the one that went around the waist, called the Lumo Back. And we ended up doubling that goal within 1 month. And that was fantastic validation for us, because we were pre-production, we had everything lined up with our manufacturing partner, and it was just a matter of flipping the switch. And for us, that campaign was a wonderful way to test, if we build it, will they come? Right? As an entrepreneur, you're constantly, patted on the back, great idea, great product, let me know when it's ready. And this is a way to really test. Are you willing, to put your money is it such a great product that you're willing to put your money down for it? And for us, that was a really nice way to go into our manufacturing with confidence that, yes, there was a market that would pay for this product because, we already had 1,700 customers that gave us $200,000 to build a product that didn't even exist yet. So that was with Kickstarter. And then I'd say about 4 months after that, we closed our Series A of $5 million, and it was institutional investors. And I think also, while doing a successful crowdfunding campaign isn't a slam dunk for raising money, because it's also known that people who invest in crowdfunding, they're a different breed. They're early adopters. They're not necessarily representative of the mass market. So while it's not equal that a successful crowdfunding campaign means you're going to raise an institutional round, it is a signal of some validation. So I think that helped as well in terms of closing our Series A. And then so we did the Series A, we brought our product to market, and then when it was time to launch our second product, the Lumo Lift, we decided, let's do another crowdfunding campaign, but this time let's do it on our own website, because we learned a lot from doing it on Kickstarter. And while Kickstarter's awesome because it has a fantastic reach, and once you start doing well, their marketing engines sort of work for you and they start promoting you, you still have this third party between you and your customer. And we wanted to build an experience where we were close to our customer. We could understand, well, where on our website do they go? Where do they spend the most time? What questions do they have that we're not answering? We could also, on our own website, design an experience and with branding that was consistent to ours. There's just a lot more freedom if you build your own crowdfunding, platform than if you go through Kickstarter.
How did you draw the traffic?
So 2 ways. We got fantastic PR. We launched at CES, and the first day of CES, we had like 20 write-ups in all the major tech and business journals. And so that helped to just draw a lot of traffic and, create a lot of buzz. And then we also did some of our own marketing, on Facebook and Google. We, did some of our own ads to drive traffic to our site.
So, the first time I visited with Monisha, and this is actually quite a long time ago, she showed me the Lumo back product, which was very clear to me what it did. It's almost like electric prod to make sure that you have a really great posture. What is the difference? And by the way, I think one of the things that characterizes success versus failure for a Kickstarter campaign or anything else that's on the web is that it has to be very clearly understandable to the people who come to your site, who spend maybe a couple of minutes reading the story. And so what it is you want to put out there, it has to be really comprehensible very quickly. I think that's one of the key things. So Lumo Back to me was very understandable. I'll have to be honest, right now sitting here hearing you talk about Lumo Lift, you have not yet given me the 20-second pitch that makes me think, oh yeah, I totally get it. Tell us what that was and why was that such a crowd drawer?
So Lumo Lift is also a posture and activity tracker. It also will vibrate when you slouch.
Okay.
How we came to it was by putting Lumo back in the market, we learned a lot. The feedback we got from our customers and also people who weren't our customers is a lot of people don't want to have a band around their waist. Second, because it's worn around the waist, it's a lot more sensitive at detecting lower back slouching, which is correlated with lower back pain. And there are a lot of people that wanted to focus more on the shoulders. They do a lot of computer work and they're starting to get their shoulders rolled forward. They wanted to be reminded when they were doing that. And another piece of feedback we got from the market, not only about our first form factor, but a lot of the wrist-worn activity trackers, is they're not terribly fashionable. They're not very wearable, especially for women who have smaller wrists, especially for people who like to sort of, mix and match with their different wardrobes. And so we really listened and we thought, well, how can we create something that is more fashion forward, that's customizable to suit a variety of tastes, that focuses on the upper body and the shoulders. And so it was based on being out there in the market that we came up with the Lumo Lift concept.
Thank you. That's a good 20-second. All right.
Oh, I'm sorry, that was more than 20 seconds.
That's all right, but I get it now. And I just want to note that your company evolved from a, I guess, a somewhat clunkier product, but very understandable, right? That has a messaging that's very clear, coupled with, I know, a lot of hard work behind the scenes to try to drive the Kickstarter and all the angel list success. And then as you got more money and more traction and all of that stuff, you were able to combine your own marketing to now do a much more what I would call sophisticated pre-sale campaign, right? And your interest in that case actually was more on how do I gather intelligence, how do I get data analytics that can help me with my product design and all the rest of it. Right? That's very helpful to know. Thank you. Ilya. I actually really love the fact that we have the kind of resources that we have and contacts that we have to get the three of you, because you are such different companies and different kinds of products and different kinds of platforms. I know you have a story to tell, too, about your own cloud and crowdfunding campaign. Tell us about your story and how you succeeded, because it's a very different route.
Yeah, it was definitely very different. So we're a B2B company.
But before he goes any further,
Yeah.
I want to say that the minute you start talking about Lumo Lift, he
I
changed
know.
his posture.
Yeah, I noticed. Yeah, exactly.
was
I
so
thought about
good.
it.
It works.
I'm going to go buy one after this. Definitely.
You just need to hang out with me.
Yeah.
I'll have that effect on you.
They work even if you're not wearing it, just by proximity. I like it. And definitely very good when you have something that your investors or potential investors could use, and they're kind of in the target market. So for us, it was a little different. It wasn't a consumer product. It was a product for digital advertisers. It was a product that was something where either people are familiar with internet marketing and with that industry and kind of understand what's going on, or they are from a very different world, or different kinds of investors. And we had both. We had investors that were very, very deep in this industry, all the way back to people that were part of the IAB, for example, the Internet Advertising Bureau that defined the standards for online marketing, all the way to people that were maybe not even as experienced as investors, that had just made a few smaller angel investments that came in later on, where we had some more social proof from the experienced people, and then they kind of followed on and filled out the round, as it were. And just like with crowdfunding, if you're raising money online through AngelList, people have equally short attention spans, if not shorter. So you have a couple minutes to very, very clearly make 1 or 2 points about why they should click that button to request an intro or contact you, or just spend time thinking about you before they just next and move on. Because there's so many startups on there. And so one of the things that we did that was successful, there's a section on AngelList that's for product screenshots, and we kind of thought about it. We looked at, okay, like maybe we can put up something that shows the product or something, but there's not really a very good way to very concisely capture the essence of an enterprise software product in a screenshot. So we're like, okay, well, this is just a place to put images, and we ended up just putting up just 2 different images. One was a graph of our traction, meaning revenue and signups, hockey stick up and to the right, and the other was a slide with logos of some of our early customers and users. And that's it. And that was maybe with a couple sentences of description. That was pretty much our page. Capture attention, come talk to us, then you can decide whether this makes sense or not. And
Brilliant.
It was something that once you see kind of enough of these other profiles that people put, and you look at the successful ones, you see that every single one of them has something that just grabs your attention. And it's not your whole pitch. It's not your only chance to get that investor. It's just an attention grabber, just enough to have them click that little get an intro button. And one thing to note, by the way, you mentioned earlier about accredited investors and all that. Accredited investor is kind of an interesting term because, at least to me, it conjures up images of professional certifications or like someone who has had a long history of investment. There's no test that you have to take to be an accredited investor. There's not a certificate that you get. Accredited investor doesn't necessarily mean that you're a sophisticated investor or knowledgeable about the industry. What it means is that you can afford to lose the money, which is probably what's going to happen if you start off angel investing. And with that, we had a very, very wide range of people that came in. So we started off fundraising. So we did Y Combinator. At the end, there's a demo day. And demo day is about a 2-minute long pitch. And we just tanked, just blew it completely, I think. I think that there were certain...
I was going to ask you if Y Combinator really helped you with your angel list campaign.
I think they did the best they could, but I don't know if it was crucial. I think it definitely helps. It was a really great experience to do it, really good advice. But our batch, there were 63 startups in our batch, and it's very, very hard to stand out immediately and grab attention. And demo day is just a mob of, for some reason, I think people imagine it to be this very, very organized, kind of very orderly thing. So there's all these pitches that all kind of blend together in people's heads, and then everyone is let loose to network or meet each other, and everyone kind of mobs some of the investors that they want to give them their card or something. There's 30-second kind of very, very quick pitch meetings, and then
by the way, when you're crowdfunding, this is magnified 1,000-fold, right?
Yeah. Yes, exactly. But when you're crowdfunding, you have a little more control over how you're perceived, and at least for a brief instant, you get to hold all of their attention when you're the only thing that they're thinking about just for that moment. And so we got some interest in demo day. We got a couple investors from there, but it wasn't really something where it was a full round that we could say, okay, we raised this round, that's it. And so few weeks after demo day, all of our investor contacts were either kind of petering out or in wait-and-see mode. Mm-hmm. Come back to us when you have more traction. Come back to us when it's proven out. We don't really understand this yet. Who else is in? Come back to us when a bunch of people that know this industry are in. Things like that. And then we decided, okay, screw this. We're just going to go make money. And we flipped a switch in our product. It was in free beta. No more free beta. Now it's a paid product. And started charging very low kind of SMB prices, so under $100 a month, just to get a few customers to prove, okay, is anyone going to pay for this? Because the one consistent thing that we heard is get some revenue, get some traction, prove this, even if it's not a lot, and then come back with a B2B product especially, just prove that people are actually going to pay for it. And we did that. I think our revenue in our first month was like $3,000, but that's up from $0, and the slope of that graph is very steep. and so we had a limited amount of time before that time interval, the x-axis on that graph, we're getting wider and wider. And we're like, okay, let's milk this thing right now. Well, it goes. You made this ridiculous, really ridiculous, like projected traction graph or something based on this growth rate. And we're like, hey, we're growing 50% a week. And some people would ask, well, what's your revenue right now? And we're like, made $600 last week, but we're growing 50% a week. So just think a few months in the future. And that seemed to be good enough for at least a few people. But I think more importantly, it really showed that we crossed that initial chasm from just nobody's going to pay for it to, okay, there's some customers that have paid for it. There's a lot more like them. We could probably get more. And then now some people that were on the fence, they started going our way. And we raised a few hundred thousand, or at least a few hundred thousand committed. And then we set up our angel list and started raising money on there. And so if I had to summarize our fundraising process, it took about 3 months total. So this was in the summer of 2011. And first month we raised maybe 200K. Second month maybe 500. And then third month the remaining amount, which was about 800, and got oversubscribed and had a lot more demand and all that. And so it was something where there's a very, very clear divide between being fundable or not, or being ready for crowdfunding, ready to scale up fundraising. And we weren't. We got a little bit of traction, a little bit of revenue and customers, and then we became fundable, and that's when we can start growing it out and kind of going through that whole process.
So I would draw a few conclusions from this. The first thing is that Ilya listened to the investors and took cues from them and changed his tack. And that's really important, is to listen and to actually adapt and evolve. The second thing is, investing, particularly at the early stage, is all about momentum, or perceived momentum, which he was able to create. Good for him. And it's also about product market fit. If you don't have momentum in the market, you ain't going to get money. And the reason is because, you probably don't have a fit. So that feedback loop is really, it amplifies itself, which is very true. I am a co-president, and I chair the selection committee for Berkeley Angel Network. I'm going to put my own plug in now. I get asked by companies, entrepreneurs all the time, to please sit down and spend an hour with them, or spend time on the phone. And the question I get asked a lot is this fundable? They ask me this all the time. Is this fundable? And nowadays, my stock answer is, put yourself in the seat of an investor and ask yourself, how would I make money investing in this company, in this play? Remembering that these investors are besieged with requests, and besieged by entrepreneurs, besieged with business plans and exec summaries. And so instead of asking, is this fundable, why don't you ask, how can I make the story so that the investors will make money with me? So that's my question back to the entrepreneurs all the time now. Now, I know that, Michael, if you had two different kinds of fundraise, with microventure and with AngelList, I bet you those experiences are very, very different, especially since you talk about one being 2 day long. And Monisha, I remember our conversation about how long it took. Can you guys reflect on, Michael, I'll start with you, reflect on how much time, what the difference is, and how much work it is for the entrepreneur, how much time they need to devote to this, in addition to being smart?
Well, I think fundraising in general is a full-time job, and I don't know if you guys would agree, but I think it definitely is, in that, especially as the CEO of a company, it just takes up the whole time. And
for how long?
I think it depends. For us, the first time, it was probably like 3 or 4 months, kind of like what Ilya was saying.
Full time as in how many hours a day? How many days a week?
I would say probably 50, 60 hours a week, maybe.
Full time.
Yeah, it's definitely full time, and I think when I say 50, 60 hours a week, I would say it's really part of it is just meeting people. And there are ways that one can kind of stack meetings and make sure that there's efficient use of that time between meetings. But at the same time, there's also a lot of time that's spent on following up with people, tracking new leads. It's in a way it's like running a business, right? Where instead of customers, it's investors, and one just has to have a very very regimented tool to make sure that one has followed up with people.
And when you said meetings, you mean literally in-person meetings?
There's also phone calls as well.
Okay.
But I think that especially when one is raising a seed round, it's a lot of people who may put in a smaller amount of money. So it ends up being a lot of meetings, like Ilya is saying. There are more sophisticated investors, and there are people who maybe have only made a few investments in their lifetime that's not in the stock market or in real estate. And so they're very new to the idea of funding a startup. And so there's a lot of education that needs to go in to just help them understand the financial instruments that we use, like a convertible note. What is a convertible note?
Uh-huh.
What is a cap on a convertible note? And things like that. It's just hard sometimes if they're newer to the investor space to really understand those concepts. And so I think with AngelList, because it's much more introduction driven, it ends up being a lot of work in terms of just spending time with investors, getting their trust, getting their enthusiasm for the product before an investment is made. And like Ilya and Manish were saying, it's all about creating that momentum and reaching a critical mass or critical stage where enough of the round is funded that people who are on the edge feel like it's a worthwhile investment to make. I think with microventures, what we found was they had a lot of experience and had a large pool of investors that they knew well. And so as a result, they were able to kind of generate and also close out funding through their own mechanisms a lot more efficiently than I think we could have done it. And so for us with them, it was more of a matter of having a due diligence done and working with them to make sure that they felt like it was a good offering.
Okay.
Yeah.
Okay.
Can
Manisha.
I ask him a quick question?
Yeah.
I know a lot of investors who wouldn't want to go through a broker because they wouldn't like this idea that a percentage of their investment in you goes to some third party. Mm-hmm. Is that an issue?
There were definitely a couple investors from the site that essentially told microventures that they didn't want to do that.
Yeah.
And I think microventures had enough people in their pool that they felt like it would be okay, so they would just make the direct introduction to us for those investors. So yeah, absolutely, there are definitely people who are uncomfortable with going through a broker and having a percentage of their investment earned by the broker.
I can also tackle that one. I like to do my own diligence, and I don't want to necessarily rely on somebody else to have, quote, especially if they're paid advisors to do that dilly for me, because I feel like they're conflicted. Okay, now, so it depends on the sophistication of the investor and also the amount of time they wish to spend, I suspect, on the whole process. And so the way they want to engage, you're basically, I think microventures is tapping into a different pool of investors. And I think importantly, too, is that Michael's story, right, the proposition, is perhaps better understood when you have a broker who can explain to a group of people, as opposed to him having to do it himself, which gets, what is convertible note and what's a cap. You start from there, and then you have to explain the whole healthcare and what HIPAA means, and it gets very complicated. Whereas for Lumobac, I bet that's a lot easier an approach. So it's just depends on the story. But Monisha, you had said also that it took full time.
Oh yeah, I mean more than full time. For our seed round, I think we spent 6 to 7 months closing the 1.1 million. One thing we did, which I thought was highly effective, is we did it as a rolling close. And what that means is we set a number of closing dates in that 6 or 7 months. And it was a really great forcing function to get investors to either be in or not. Because that's one of the things that's hardest when you're an entrepreneur, you're out there pitching. when you keep hearing the maybe, oh, tell me more, or come back to me. And after a certain point, you just wonder, gosh, should I keep investing in this person? Are they really serious or not? And so by having a rolling close, so for example, our first close was in October, went to all my investors, or people that I've been talking to, saying, and I said, we're going to do our first close in October on this date. There may or may not be room left in the round, so if you really want in, here's your chance. And, of course, there was room left in the round, but that was sort of a time when people would either say, yes, I'm in, or, you know what, no. And so with each rolling close, there's less and less room. And so it's just a great way to create some urgency. Because I found that for me, the hardest thing is all of the fence sitters, right? And you just don't know if it's worth your time to continue talking to them.
Absolutely.
So I heard a few things already. My next question was going to be, what are the 3 success factors? I think the panelists have already hinted at a few, right? The first one is rolling closes or create a sense of urgency. The second one is create momentum, right? Show them how your company is having traction in the market, and how your funding the process is tracking in the market. Do you guys want to add any more factors to that you remember or feel is important to share?
I can add one thing. So the big way to create traction is obviously with customers or whatever else, but the other way to have some kind of traction is through social proof, or through having someone who is either a sophisticated investor, a well-known or brand name investor, or having some indicator that someone else is backing this and has vetted it. And so this is why AngelList is also really helpful, because it says right there on your page, this is who's investing in this round right now. And when you can show that and just very, very quickly have that added credibility and that almost like a halo effect from someone else's brand, that is very, very helpful. I think.
Would it be helpful for the people in the room and also on the internet for them to think about maybe impressing one super angel who maybe is active on an angel list kind of a thing? Is that a valid approach?
Yeah, it's definitely something that will help, and I think the thing to remember about fundraising is that it's really, really hard until it gets really easy, and there's not a lot of in between. And so it's always really, really hard to say, okay, go impress a super angel, go. I think that is definitely something that you should do, but it's very hard to make that actionable. Something that a lot of entrepreneurs do, though, is that they, at the very least, even if that super angel or that well-known investor hasn't committed yet, they will get on their radar, maybe have that initial meeting, and then come back to them to jump in, because maybe that super angel is waiting for another super angel to come in.
Mm-hmm. Anything else? Anybody else want to jump in with on success factors?
I will. I think in the same way that you have to find the right market for your product, you have to find the right investors for your business. So you almost have to even think about your business as a product. And what that meant for us, especially in the earlier stages of angel and seed, there's a ton of risk in your business. And so you've got to find the investors who are going to connect with your business for reasons above and beyond potential financial gain. Because it's likely to fail at that stage, right, statistically speaking. And so, of course, you need to show that financial upside. That's necessary but not sufficient. The other part of it is finding the investors that, for some other reason, they have an emotional connection with either you, the problem that you're solving, your industry, for some reason for becoming involved. So, for example, we have one investor who's in Europe, and his reason for wanting to be involved is he used to be in the Silicon Valley, and he wanted to feel connected again to, all the innovation that's happening in the Silicon Valley. And because he had he had gone to my business school, many, many years before I had, it was also a way to feel connected back to his alma mater. I think that was a big part of why he invested, in addition to the fact that he really loved our idea. And so that's the advice I would say, is especially in the early stage, try to find that right investor fit based on, their interests and their passions, and why you might help them sort of on that emotional level for why they would want to invest.
One of the things that I advise entrepreneurs who come to me, and I feel that they're not really quite ready for organized angels, but could interest a super angel, when I suggest that they connect with a super angel, say, how? This is really hard. My advice actually has been, look for somebody who has exited, made money in your sector, okay, who understands your sector and how what it would take to succeed, and therefore whose advice could be actually of value to you, and also would be interested and connected with what you're doing. So that's one way. It's not an easy way, but it's certainly one way to identify somebody. Okay, I'd like to take some questions from the floor.
I've been wondering, listening to you, is it essential for credibility with potential investors that it be the CEO out there making the pitch, or does a really good salesperson or marketing person who's helping you, can they be effective?
I'm going to repeat the question for the streaming. Is it essential for the CEO personally to make the pitch, or can a really good marketing person or salesperson substitute?
I would say that it doesn't necessarily have to be the CEO, but it should definitely be a founder. Investors, especially at the early stage, they're really investing in the people and in the team. There's not enough of a product or traction yet to really invest just in the product in the way a Series B investor would. So much of it is about the early team, and usually if the founders are really, really strong, they're going to attract very highly talented people to join them. And so it's very, very important that you realize that the pitch is as much about yourself as a founder as it is about the product or the idea and whatever else. And like was said before, the investor has to like you. The investor has to believe that you're going to be the one that will make this really, really big and that can build a big company.
You guys want to jump in?
I would agree.
Yeah, I would agree too. I think that if it was just an employee, it would probably send the wrong signal to the investor about the founding team, and I think it would raise a question about why isn't the CEO or CTO or the co-founder involved. So I think it does help to really have a member of the founding team there.
I would actually make it stronger personally as an investor. Our group, for example, requires a CEO to present in person, not by remote, not send a delegate. And we've had companies fail because the CEO could not make it that night and didn't tell us, and we kept a spot for them. So right up until the company is about, I don't know, $30 million in revenue, okay, or 300 people, the CEO, and in fact, even after that, the CEO always is the most important person who defines the culture, is the most important advocate for the company, is a person you want to stare in the eyes as an investor to make sure that they're going to deliver, is a person that you can build trust with. There's all kinds of reasons why. But in the early stages, you're investing in the team more than anything else. And I have always said that a great team can make any business model, any technology sing. A lousy team can tank any great technology. And so it is always about the people. I'm going to... yes, sir.
Yeah, so when you open up for a crowdfunding, what happens to your IP? How do you protect your IP?
Okay, the question is, how do you protect your IP or even your idea, potentially, right, if people want to be in stealth mode when you're doing funding via the cloud?
We made sure to have our filings before we went very public, or we didn't disclose a lot of our, proprietary things if we weren't ready yet. our belief is, most ventures are, 10% inspiration and 90% perspiration. And so there are very few ideas that are so awesome that if you go out there and tell the world that, oh my gosh, somebody's going to replicate it overnight, if it's that easy, it's not that great of an idea, because it's usually in the execution. So we've always erred on the side of probably oversharing, and in so doing, we ended up attracting a lot of amazing advisors and investors that connected with what we were doing.
Yeah, I would also agree with Manisha. I think that there's no idea without challenges, and so it's impossible to say like, well, we're going to make a PageRank algorithm to do search and have like 100 people copy you the next day and do it better than you if you really know what you're doing. And so I think that advice we got when we went out is, if there is some sort of secret sauce, you probably don't want to share that with everyone. But in terms of providing a very compelling, concise story that can attract people, that can be done with any product. And so it's really important to actually share that with as many people as possible so that you can get resources like great advisors and great investors to be attracted to it. And you can definitely do that without giving away your secret sauce.
Yeah, I would completely agree. I think a lot of entrepreneurs are, for whatever reason, irrationally afraid of people stealing their idea. The idea is maybe the first month of building a company, and then you have years and years of the slog after that. There's probably a good amount of entrepreneurs that kind of sabotage themselves by worrying about this too much. If you ask investors to sign an NDA before you pitch, nobody's going to do that. You're just going to kill your pitch, so don't worry about it.
So I get a lot of entrepreneurs, not a lot, I would say probably 10%, who come to me and say, well, we're really in stealth mode. And honestly, I have no patience for that. If you're going to be out there looking for customers, you're going to tell them what the heck you're doing, right? And if you are going to be making a persuasive argument for people to invest in your company, you had better tell them what it is you're doing and why it is that you're worth investing and trusting and all the rest of it. So I absolutely agree that idea is a dime a dozen. It's the execution that counts. And so at the end of the day, it's how you make it happen. It isn't about the idea. So IP is important, absolutely. Keep some things back, absolutely. And frankly, if you want to talk about what your IP is and what your filing was about, everybody's going to have their eyes glazed over already. They don't want to hear that. They want to hear about your value proposition, your go-to-market plan, your business model, your revenue model, your expectations, your team composition, the things that don't matter in the scheme of things in terms of trying to be a stealth mode. Okay, so I'm going to ask another one that came from the streaming and the registration process. Talk about hidden costs, both in terms of real cash money up front that maybe people don't know about, especially, for example, like broker-dealer. What does that mean? Or even process-wise, but also impact on future funding prospects and other things. So hidden costs, both in real money and also in opportunity cost.
I can tackle part of that. I can't think of any opportunity costs other than your time. I mean, when we did especially our first crowdfunding campaign, I mean, it was 80-hour weeks for me, easily. And when you sort of do the, how much money did we make per hour versus the amount of time that I put in, like, it's not, a great financial proposition, especially, and then I wasn't the only one running the campaign. My co-founders were very involved as well. So a lot of, man hour went into that. And was it worth $200,000? Probably, we came up short. But so there's that. But you have to do that, right? I mean, whether you're making $3,000 a week or $200,000 from a crowdfunding campaign, that's how you get the seed started. In terms of Kickstarter, there's a fee that you pay to Kickstarter. I believe it was like 5% of the sales, so that's a little bit painful. But the benefit is you get a reach that you wouldn't have otherwise. Of course, you have to also pay. I think Amazon was the payment system, so you pay another 3% to Amazon. So there's those hidden fees. But in terms of opportunity cost, I can't imagine what would have been a better use of that month. Because it was validation.
Okay, Michael.
Yeah, I would say with broker dealers, there's definitely a percentage that they take. It's somewhere between 0 to 5 or 6%.
Can't be 0.
Okay, I'm sorry. Between something low to 5 or 6%.
Okay.
And it depends, I think, on who you use and how you would negotiate it with the broker dealer. Other than that, I think really the opportunity cost, like Monisha said, is just time. I think that because it is a full-time job, what you end up doing is you can't really do too much development on your product as an individual, and so the rest of your team has to pick up the pace and pick up that burden, and so it can definitely slow down progress on the product, progress on customer traction, and so that's also something to be mindful of. And then in terms of future rounds, I think Monisha is the one who's raised a larger Series A round, so I don't know if you want to talk about that, but I honestly think that with later rounds, it's all about how good the product and the company is doing. I wouldn't worry too much about how a previous funding was perceived. If we were building Facebook and we were just exploding and we had used, I don't know, whatever funding mechanism, no VC on Sandhill would be like, I'm going to say no to this.
No, wait a minute. Yeah. I have heard CEOs tell me that they've got, I don't know, 15,000 from somebody, and that somebody will call them every week to ask for an update, or sometimes expect to have a meeting, lunch meeting. So to what extent, and you're the one that actually talked about, they want to know about what a CAT means in a convertible note.
Yeah.
To what extent does the fact that many of the crowdfunding participants are not terribly well-informed investors or even sophisticated investors, to what extent did that impact what you're doing?
So when it comes to our angel list investors, because there was a vetting process, and there was more introductions than anything than anonymous people. We made sure there was a good fit. In terms of
what does that mean, good fit?
People who wouldn't do exactly that. I can't answer weekly calls or questions. It was people that wanted to add value, but also understood that you had a business to run. And
may I ask you what the average investment was on Angel List?
100,000.
Okay.
Yes.
Okay. Well, then they deserve a phone call anyway.
Oh, yeah.
If they wanted a phone call.
Absolutely. But yeah, exactly. And so when they ask, I do respond, and I provide quarterly updates and things like that, so that they are in the know. But yeah, I have heard of some investors who, it's kind of interesting, someone who actually said there's sort of this disproportionate relationship, that the less they put in, the more sort of needy they are in terms of wanting to feel in the know. And so maybe that was a good sort of filter as well, of having a higher threshold for minimum participation, because you have investors who understand that you can't spend all your time answering their questions.
Okay. Ilya, you had the benefit of Y Combinator and arguably pretty sophisticated super angels and or angel investors connected with that. What is your perception about the sophistication of the investor base that you have from what you want?
Yeah, that's a very important point. So I think everyone has to remember that when you're pitching and investors are evaluating you, you are also evaluating them and seeing if they're a good partner, if they're a good fit, because you're signing up to be partners with them and to be involved in business with them for years and years and years to come. And so it's very, very important that you have investors that share your vision, that have the right expectations, that are sophisticated, that understand how startups work. And so our investors have been fantastic. They've been really, really helpful. They're always there when we need them and don't get in the way when we don't. And a big part of that is that we actually said no to quite a few people. We were, especially towards the end, we were quite selective with who we'd let into the round. And it's always really, really hard starting out to say no when someone's kind of dangling that check in front of you. But you have to think about, well, what is going to happen in the long term? If things maybe aren't going as great, hypothetically, how will that investor deal with that? How will they still be there for you? Will they be helpful? And so it's something where not the same as a customer where you can just take their money, give them a product, that's it. This is a partner, and you have to be really cognizant of that and find people that will not just be easy to deal with right now, but based on their track record and whatever diligence you've done about them, will be a good partner for the long term. There's so many startups out there that died because they had bad investors. It happens.
So compare and contrast, if you would, the quality of the advice you have received, Monisha, from your angel list people and from your VC. And talk about the quality of the advice, the quality of the association, and how would you do it differently, if any?
I mean, the quality of the advice across my angel investors really varies. Even some of my angel investors are professional investors, and so I'd say for those who are professional investors and or were entrepreneurs or are entrepreneurs, the quality of advice is very high because they either spend their full-time jobs thinking about this space or did. And then certainly the institutional investors, for example, our board member from our lead, who was our lead, very, very good advice because that's their job, right? They are hugely invested in your success. So I'd say angels, mixed, institutional, tends to be really good.
Okay. And Michael and Ilya, as you look forward and at the same time look backward, what worries you about your next round? And what would you do differently now, given the benefit of hindsight?
I think one thing that if we had to raise a seed round right now that we would do differently is we would probably be a little less worried about offending investors or pissing them off or just somehow scaring them away.
How do you mean?
Well, for example, there are some investors that said, well, give me your projection for your revenue for the next 3 years or for the next 5 years. And I would say, I don't know, we'll try not to lose your money. Because you just don't know when you're so early stage and you've just had a product out for 2 months. You can't say what your revenue will be 3 years from now. And we kind of, at least early on, were very, very cautious along the lines of saying no to people that weren't a good fit or of just being something that they would say, well, this is not a good fit for me or I don't want this. And I think if we were to do it again, we would be more comfortable with saying no to some people that are not a good fit, not kind of looking for the same thing that we're looking for, and essentially we wouldn't waste time with a lot of these deals that ultimately went nowhere, but we thought might go somewhere, and we kind of would humor them or indulge them and things like that. So we would move in general a lot more quickly. I think, as was said before, the worst thing is the ones that are on the fence, that are kind of maybe. We would want to get a yes or a no relatively quickly and just get it over with. It is absolutely a full-time job get it done, get back to work, and getting money from customers.
Okay. What about looking forward? Next round, any worries or any hopes?
I hope there's not a crash. Yes, soon. I think that in the next round, so that would be for us an institutional Series A round, we would be talking to professional investors that have done this a lot before, that have seen the trajectory of startups. I think that the biggest pitfall for a lot of startups is that either they go to the wrong investors that are not a good fit, both in terms of where they invest, industry that they like, the stage that they like to invest in a company, or even just someone that you can't really see sort of being on your board for years and years and being a close partner. So I think the biggest thing for us and the biggest kind of consideration that a lot of startups should look at is that you shouldn't take money from the first person that gives you money. You should really look for someone that will be a long-term partner for years and years to come.
Yeah, one of the things I like to say when I advise companies is you have funding risk, of course, as a startup because you may not get money. You also have funding partner risk because as you will march down that path together for years to come, their advice and their opinion and their direction to you and their reaction to your proposed schemes will influence the path that you choose to take. And the quality of that partner is all important, isn't it? Michael, any thoughts from you?
Yeah. So I think it was a multi-part question, right? So,
Yes.
So I think in terms of kind of looking back, I think just going back to your previous question, like our investors have been great. They've been giving us really good advice. We don't have any investors that invested, $15K and are badgering us every day.
What was your average?
We had a minimum of 25,
okay.
But we got a lot of larger checks.
Okay.
And so I would say that there isn't there are a lot of investors that that we have actually who are doctors who really understand our space, who really understand the need for what we're doing, and have given us really good advice on how to improve our product and how to make sure that it's useful to the end user. I think in hindsight, I think, like Ilya is saying, I think as an entrepreneur, when you're kind of, especially early in a fundraising round and you're kind of essentially begging people for money, it's really hard to feel confident and push back when they ask for unreasonable materials or, they have questions that just, it's hard to answer. But I think that as you become more and more experienced on how investors think, it almost becomes a necessity to just be like, look, I can't give you that information, or it doesn't make sense for us to do this, and it might just not be a good fit if you really need that information. So I would definitely push back a little bit more. In terms of looking ahead, I think when I look to kind of future fundraising rounds, I think it's really important to have milestones in place. And I think one way to do that is to do some reconnaissance early, talk to who you think could be your next round of investors, whether it's institutional investors or whoever, and just see what milestones are they looking for. And I think especially if it's an institutional investor who understands how, for us it's healthcare, they have a very good sense of this is the type of thing that we like to see in when we look at companies that are selling to hospitals or selling to whoever. And so from that sense, if you poll or talk to enough institutional investors, you can get a very clear sense of where one needs to be.
Mm-hmm.
And I think that that's important for both as one looks to the next round, both for yourself and your team, but also for your previous investors, so they know that you have a bridge or a road that you believe you can accomplish to reach whatever next step it is.
Yeah, funding is a full-time process, as you heard from the CEOs here, at any stage. If you just go out, somebody here said, I think it was Monisha said, it's a sales process, right? It's selling a product to your customer or is selling your company to an investor. It's a sales process. So I have, in my own practice, always preach that if you're not ready because you don't have a product, don't go out and try to sell because you're just going to be wasting your time. And so in a real sense, you want to prepare and be ready for that sales process before you want to engage with your customer. So you want to be ready, your company has to be ready for the investor's appetite. And so doing the research, just like you guys are here, listening to the process, understanding the success stories, figuring out the tips and all of that stuff, what's it going to take for you to be successful to fundraise from the cloud? It's the same thing for the VCs, the same thing for the other angel organizations, whatever it is. Engage with them early, invest some time to research, figure out what that they are looking for, and make sure that when you go to them, that you can help them understand how they can make money with you by delivering those pieces that they're looking for. Yes, sir.
Yeah, question. This goes back to Ilya's comment earlier about the 3-year revenue forecast or something. All of us in this position, we go, okay, we know what it could become. We also aren't wanting to just hype people. We know what might be a more conservative scenario. How do we properly respond? This is probably also for you, Kathy. How do we respond in integrity knowing that there really is 2 different numbers?
Okay, so let me repeat the question for the streaming. In the 3-year projection, how do you, with integrity, put down numbers that you believe in on the one hand, but on the other hand, will attract the investor by showing what could be?
Well, for us, I think what we saw very quickly as we talked to different types of investors and had a bunch of these meetings, I think a lot of the more experienced early stage startup investors will just know that many of those numbers, even if you have them, are fairly meaningless. I think that the more important numbers that you could show about the market or about the demand, you could say, well, this is a very credible and realistic projection of what the size of the market is and what we could capture market share wise, or you could say, well, this is how we can build out our sales pipeline or our marketing channels or whatever to get to that next milestone and kind of stay realistic or at least plausible. And I think that for a lot of those investors, they want to know that there's a really big market there. They want to know that there are, at least in many cases, some kind of comparables that you can point to that have done really, really well. And they want to know that you have some kind of plan or some kind of path forward to be hitting those milestones. Even if that's going to change, if you have a starting point or some kind of path to eventually, many years down the line, being a $100 million revenue company, then they will take some degree of comfort in that, at least, even if it'll change over time.
I mean, ditto. They just want to know you're swinging for it and what you're swinging for, but they understand that the numbers are going to change.
So I invested in a company last December, and as soon as this quarter, right, they already missed their target. And cynical response is, oh, so soon. It's absolutely true that you know as a experienced investor that you're expecting the companies to miss and that they're trying to put a number up that is going to appeal to your sense of, wow, how great this could be. And so, this is why experienced investors discount to projections. So you need to know that. However, what I also like to see is very grounded. He says plausible. I say grounded approach. So if you say, oh, the world is, 7 billion people, and if I just take some percent of that, I'm good, right? I'll reach 0.1%, therefore I'm good. I'm going to be 100 million. That's not good enough. So when plausible, grounded, what I mean is that you have a real approach to capturing a particular segment of that market, that you can connect with them, and then you can show traction that actually people are paying you money to actually, to buy that product or service. So it's coming from both sides. So on the one hand, you want to say, hey, the market is out there. If I execute, I will get there. And then you have to then show the investor your execution plan. And then it has to be grounded and believable and actually doable. Okay, I have.
So I have a question.
Okay.
It goes to the points that Ilya and Manisha made about really needing to vet out your investors and know your investors. And I think one of the things about the cloud is that can make that quite a bit more difficult. I think, Mike, you had an experience where you raised your money in 2 days. How did you get comfortable that those investors were, as Manisha put it, the right fit? And have you seen any distinction in your relationship as it develops with those investors that you got through your microventures experience and those that you actually went out, made a relationship with, and then got their investment?
So the question is, we emphasize fit. How does that work in the crowdfunding funding from the cloud space? Number one, and number two, Michael, in your microventure versus angel list experience, was there a difference between whether you figured out what the fit was?
Yeah, it's a great question. I think for us, so the way that microventures works is that they actually create like an LLC specifically for funding the various offerings. So for us, it's a separate LLC where microventures actually is kind of the owner of that LLC. So from that standpoint, we actually are in some ways, one person or one connection away from those investors. So as a result, what we do have is we have a great relationship with the people at microventures, and I'm very good friends with the founder. They provide us with advice themselves about how to kind of craft our business and kind of business strategy, and as a result, I don't have this sort of direct relationship with the investors who invested with them into the LLC, because I think they aggregate that money and put it into the LLC themselves. Whereas with our angel list investors, it's a much more personal relationship. So, every quarter I'll send out an update, and I will have oftentimes personal phone calls with them to tell them where things are, and they'll give me advice directly as well. So it's a different relationship, I would say. But at the same time, with the microventures funding, we've been also getting a lot of really good advice and benefit from that as well.
From microventure or from the investors?
From both. So there will be some investors that feel strongly to reach out directly. There's a lot of people in healthcare that are also part of their platform. So there's one physician, for example, who just sees a huge need for this sort of software, and so he's been instrumental in getting his organization, his healthcare system, to look at our platform.
That's the best kind, isn't it?
Yeah,
An
exactly.
investor who will help you with a customer.
Exactly. So there are definitely people like that who will directly reach out to us.
Ilya and Monisha, you guys have anything to add?
In terms of the having a good relationship or managing those relationships.
And how do you filter and how do you figure out who's a good fit?
A lot of it is it's chemistry, honestly. It's just that connection.
That means personal contact.
Yeah. And it's that, belief that I loved it. I thought Ilya said it well, be there for you when you need them and get out of the way when you don't, and that sort of understanding on their part that, that they want to add value and you're very open to the value, but you also need to be allowed to run the company. And so sort of for us, that's what the right fit is. And in the process of getting to know somebody, if that's who they're going to be.
I would add that in all of our investor meetings, there was one common pattern or signal where if we saw this, we would know that it's a really good investor, it's a good fit. And that's when during the pitch, even before they commit to invest, they start brainstorming with you and thinking about ways that either you could build out the product or that they can help you or make connections. That told us two things. One, they were a lot more likely to invest if they're already thinking of ways they can put their network to work for you. And two, is that they actually care. They're actually thinking about it, and they will continue thinking about it and being helpful and kind of being actively involved in some way. The worst meetings were the ones where you could tell that clearly they're not paying attention, or they're not interested, or they're thinking about something different. The best ones is when you start thinking about strategies and tactics and kind of, okay, it almost feels like that investor is already on your team and on your side and already working to help you be successful.
I'm going to ask Adrian Rich to come up and join us. Dorsey and Whitney is a sponsor tonight, and Adrian has been helping us on the committee to flesh out understanding of the evolution of the laws that impact crowdfunding, the whole subject, and I mean not the legally defined term, but also the broader thing. You can have my mic. So come all the way up here, Adrian. I have a last question for the panel, but I think it would be important to have a legal guy here to explain some of the evolutions and changes that have happened. The last question is, in the second half of 2013, the SEC released a series of no-action letters. Thank you, Julia. No-action letters that clarified the law in substantive ways. What are your views about the promise and dangers of crowdsourced funding? Does the uncontrolled nature of funding process worry you as an entrepreneur and as a citizen? So before you answer that, I'm going to ask Adrian to help us understand a little bit more about the various instantiations or business models that are out there from the different sites that may trip up an entrepreneur, or for that matter, as they think about selecting a site to use as a platform to fundraise. What are the implications?
There we go. I hope everybody's ready for a long speech. No, I'll try to keep it short. I think there has been a lot of change, and a lot of what you've heard about tonight, Manisha and Ilya in particular. They were working under the law as it once was, and they were working with AngelList when AngelList would make introductions. They'd make sure you were a credit investor, make introductions, and then you would go off and do whatever you did, and you were kind of responsible for it. And as we probably all know, there's been a lot of changes. For example, the general solicitation ban. That's the idea of you being able to hold a sign saying "I'm looking for capital." Has been lifted as long as you only take money from accredited investors and you make real efforts to make sure they're accredited. Much more difficult than it once was. And there are proposed regulations as it relates to crowdfunding. And when we talk about crowdfunding with the SEC, we mean true crowdfunding. Kickstarter of securities. We can take money from everybody, little bits and dribs and drabs, but we can take it from everybody if they're accredited, if they're unaccredited. That's not the law yet. That's still out there, and we'll see when that happens. The SEC is not moving quickly with respect to that. They're very nervous about it. To the implicit part of Kathy's question, they're very nervous about fraud and all those types of things, and not protecting the accredited people or the people who are rich enough to lose their money, as you said. And so what you've heard discussed on the panel tonight, and what you'll see out there on the internet, are a whole host of different choices. One of them, the microventures and others that are like them, affiliate themselves with broker-dealers. And they are not really taking advantage of any of the new law. They're just using old law in new ways. We saw the same type of thing back around the late 1990s, and it's come back. And it's been very successful, more successful now than it was in the past. I think because people are used to the idea of social investing, and really we use the internet more than we ever did. There are quite a few other choices. General solicitation ban has led to, or the lifting of the general solicitation ban has led to a lot of websites out there that will allow you to advertise that your securities are for sale. The securities law compliance of those websites and use of them is uncertain at best. And it's something that you want to make sure that you are in close communication with your lawyer as to securities law compliance, and if you choose to use those tools, and many people do, and many people do successfully, that you do so in a way that that minimizes your exposure, because it truly is unknown right now. The SEC is taking its time in putting out regulations that give us certainty. So I think that's the
fund model.
Oh, yes, and of course, as we know, AngelList and a couple of others have developed a different model. AngelList used to just make introductions, and they didn't take any part of the transaction. There were no transaction fees. And about a year ago, maybe a little bit more, they went to the SEC and said, hey, we'd like to create these funds. and we'd like to get some type of return from what we or the people who are participating in the AngelList community are doing in order to allow companies to get funded. And so the Angels List went and got a no action letter, as did Funders Club, on two different theories, but basically on the idea that they would participate in upside of investments. So they can't get any transaction fees up front, which broker-dealers can, but they participate in upside over the length of the investment. So that's a third middle ground. And then we have all of these bulletin board websites that have developed, which charged fees in a different way, in several different ways. Some of them charge fees based on a percentage. Some of them just charge a technology access fee, and others. And really, the key is that you have to be in close communication with your lawyer to make sure that what you're doing is not going to cause you troubles. Because if you violate the securities laws, many investors in the future, the venture investors, and even acquirers, will either walk away in the worst case, or really ding you in your valuation or your holdbacks or otherwise. It can harm you. So paying attention to it early on is important, and understanding the risks that you're taking.
Thank you. So I'm going to ask this question again in a different way. In our first panel, we had a bunch of angels and super angels participating. In fact, we had a VC as well. And the focus was really on the new laws and the new different kind of sites that are out there and what the implications were. And much to my surprise, of that whole panel, not one person has invested via a crowdfunding or funding from the cloud site. Some of them have invested in companies that were going to be a site. And quite a few of them were very, very concerned about the whole crowdfunding concept and particularly the abuses. And at the time, I think at the end of that conversation, I think the conclusion, general consensus, was that, yep, this space has got about 3 years of evolution going on. There are going to be orphans and widows who are going to lose money. Congress might actually have knee-jerk, legislation to counteract its own legislation today. And at the same time, it ain't going away. It's a new floodgate that has been opened. A lot of money has already changed hands. It's a new model that's going to stick around, and you had better embrace it and figure it out. So given all of that, and we have 3 entrepreneurs here who have successfully raised money, who have gone on to raise VC money, and who are doing very well, who have a different perspective. But I'm asking you, both as entrepreneurs and as citizens, right, what your forecast, hopes and fears are about this whole space.
I think there's a lot of opportunity possibly in this, but there's also a real danger to true crowdfunding. So when you have unsophisticated investors that are not very tech savvy or very experienced, that are buying small amounts of equity online. And the real elephant in the room with this, the big danger, is that if you ask any startup, they would always prefer to take money from sophisticated investors, from professional angels, from people that can add value in other ways. That's always the preference. And so what you might see happening if there's all of this crowdfunding is that the best startups, the ones that are most likely to succeed, not much is going to change with them. They'll still go to venture capital firms, to angel groups, to sophisticated investors, and that's where they'll get their funding. And the startups that are going to be going out for crowdfunding from just the mass anyone are the ones that are unable to raise money from professional, higher quality, if you will, investors. And so if you think, well, most startups already fail, startups are already a very, very risky bet. If you have something where the startups that are even less likely to succeed, just statistically speaking, are the ones that are going out and getting crowdfunding, then it's something that could potentially end very, very badly a few years down the line when they can't get the next round, they can't raise the institutional capital that they need to scale, and so on.
Okay.
Yeah, I mean, I would agree with Ilya. I think that, I think true crowdfunding where really unaccredited investors and even some accredited investors, they may not be as knowledgeable and not as experienced. I think there really does need to be some sort of regulation and some filter around just how it's done, because I think, like Ilya is saying, there's just so much risk attached to startups, and sometimes it's even outside the startup's control. There could just be things that happen in the market or things that could just make it hard to succeed, and for people who are really unfamiliar with how much risk is involved, without a clear understanding of what may happen to their money, I think that it becomes an even riskier proposition than for experienced investors who understand the risk and may have a much larger portfolio where they've tried to mitigate that risk through diversification.
Now, Monisha, as somebody who's gone through all of the different kinds of funding sources, right? You've covered them all, except for the organized angels. One of the things that I think about is, what does it mean for the venture guys, for the people who are out there looking for money? And I would say, good for you. If you can find funding, whatever means, go for it, right? Get the money, okay? That's the first thing. That said, there's definitely quality in the funding source, right, as everybody is saying here. And I speculate that instead of what VCs say today to the entrepreneurs, show me some traction and we'll talk, right? They're all saying that. Show me some traction, we can talk. I don't know, 2 years from now, when the SEC finally gets its act together and true crowdfunding happens, maybe they'll begin to say, well, everybody's getting money from all kinds of sources. They'll begin to say, I'm going to wait till you're a category leader before I fund you. So looking at it from a entrepreneur's perspective, is water getting muddier? Maybe early stage funding gets a little bit easier, but maybe later stage gets harder. How does that look?
That may potentially be what happens, and I'm going to take a contrarian view to what has been said, partly because I don't have a well-formed opinion yet, and because it's more fun to disagree. The other, argument against what's been said is crowdfunding enables a shift in power, right? I mean, so for example, Pebble Watch is a perfect example of that, right? They had gone up and down Sand Hill Road trying to get money to start their smartwatch company or to give it traction. Denied, denied, denied. They go on Kickstarter and they raise $10 million, right? The market spoke, and they had the money, and now the company is just doing incredibly well. And of course, now the investors want to invest. I love that story because it's a shift in power, right? And I think it is healthy for our economy to have that kind of competition, if you will. And if you have a great idea, if you have a great venture that resonates with people, you're doing something right. Whether it's a sophisticated investor or not. I mean, yes, we can argue that, and certainly, I wouldn't want to see orphans and widows lose their money. But in the grand scheme of things, in the big picture, is there more benefit or harm? It could be argued that there's more benefit.
Fair enough. Just like the internet has disrupted all kinds of different business models, where the middlemen ended up being basically disintermediated. I remember in 1995 when I was in investment banking, and we went around visiting all kinds of companies talking about the revolution called the internet. The speculation back then, even, this is, gosh, how long ago, was that the idea owners, the content owners will win. Even back then, 18 years ago now. And that is coming true now. You see all kinds of different ways where people who design, people who have the ideas, who publish, who write, who do this, that, and the other thing, who no longer need the publishers or the channels or the retailers or whatever it is to succeed. So on that note, I'd like to end the evening. I want to thank Enterspace for hosting us. I want to thank Dorsey and Whitney for sponsoring us. I want to thank VC Task Force for organizing and being the platform, and of course, especially our panels tonight for their wisdom. Thank you.